We're going to just start recording. Okay, we are live. Welcome everybody to tonight's live Investor Agent webinar. I appreciate you being on board and participating. We are live and we are recording. And for all the new folks, if you're new to the program and this was your first webinar, you'll notice a few things. We are automatically in mute mode. Everybody's by default in mute. And that's because obviously it'd be difficult to have 100 people trying to talk at the same time. So use your question box to type in questions, okay? And I will respond to you online here live. From time to time, I will unmute you. So we've done that in the past several times, okay? Also, the recording goes out the very next day. So if you're listening to this in recorded mode, just remember to always check your emails from Beverly the very next day after a webinar. She's going to give you the recording, the webinar schedule, and also any other important information related to the program, updates, changes to schedules, things like that. So it's really important that you do that. Also, I've been mentioning this the last couple of weeks. I've seen more of you put your profiles out there online. Absolutely put your profiles out there on the community site. The reason is we're getting a lot of action going back and forth between people, and I think I mentioned this last week. I've already spoken in a couple different places, Mexico, Canada, Ireland. I'm going to London in September. And the reason that's important to all of us agents here, particularly you, is they're investors, and we're going to be putting them on the profile site to find you directly. And some of you have already been working with international investors, so kudos to you. So you know what I'm talking about. It's really important that they can find you, because one of their big issues is trust. And what they've been doing is providing funding to their family members and telling their family members to go make it work. It's a very good scenario. So they're being trained, some initial training. The only way they can be on the website and find you directly is through that method, just like you're on there through training. And we want them to be trained to work with you, and we want you to obviously be trained to work with them, which you are. So in any case, enough said. You definitely want to get your profiles out there, guys, okay? And help me help you as much as we can. So in any case, first things first, welcome to all the new folks. If you're from Oklahoma, Texas, even some probably brand new folks from Albuquerque. We just taught an investor group down there on Saturday. And there are a lot of agents there and investors, of course, okay? I'm in Colorado these next 2 weeks. So if you're from the Colorado area, I was out here last August. Please let me know if you want to meet, and we can meet you one-on-one. After that, I'll be in new territory for the remainder of June and the balance of July up in the Northwest Territory, and I have to complete those regions. I haven't been there yet. So in any case, always check for my schedule online. You can look at that directly, and also check the time trade for scheduling one-on-ones with me. That comes in all the emails, okay? So in any case, so far so good. What we want to do, guys, is pick up where we left off last week. We went over the process on how do you actually work with landlords, people buying rentals, okay? It's a 12-step behavioral process. Now, the reason this is important is I can teach you academic skills fairly quickly. I can go over calculators and spreadsheets. In fact, we're going to do that tonight. The behavioral skills are habits, so they take a while to form. It generally takes about a month for you to actually get that up and running in a way that you can make it work for you, okay? But you have to practice, okay? You can do role playing amongst each other. You can practice on some of your existing clients, but the bottom line is you've got to actually put it into work, put it into place, okay? It works very well. So we did that last week. That's the behavioral skills last week. That was the 12-step process. Tonight we're going to go into some calculators and spreadsheets, okay? Later on we'll follow up with flippers. How do you work with flippers and some of their calculations, which are a little bit simpler than rentals, okay? In any case, so what I want to do here, I don't want to go into a lot of the details here in the beginning of this section. You can all read this, and obviously at some point you've got to actually crack a. So we talk about A, B, and C properties in here, and then I give you an example. So what I want to do here, let's go through this example right here. This is a property going way back, I don't know how many years ago, 10, 15 years ago. We're going to go over the numbers, okay? And then we're going to go into, and we're going to use what's called the cash flow worksheet to explain how we use this. So this format you're seeing on your screen right now is using what's called the cash flow worksheet. That's all of you have it in your training material. We're going to do this one first. Then we're going to go in and use what's called the rental property evaluator. It is modeled after the CCIM opportunity evaluator. We're going to take this property or any property you want to bring online here, and I will analyze it for you. We're going to do some what-if scenarios on that Excel spreadsheet, which I'll show you here in a few moments. The third part is we're going to go to what we call Rental Property Reporter, an awesome online tool. The second one, the actual Excel spreadsheet, is more about a snapshot in time. You can do what-ifs, snapshot in time. The third one, though, the Rental Property Reporter, guys, is a little bit more elaborate, a little more sophisticated. It actually provides projections for you, okay? It shows you what will happen with that property if you did purchase it, what will happen, likely to happen in the next 5 years. So people like financial planners, accountants, those guys really love that one. Engineers, of course, accountants, and most people like the second one. But we always want to start right here with this very first one, okay? Hey, we do have some guys on from, hey, Rob, welcome aboard, man. Hey, so Rob, what we're going to do tonight is we're going to go into a little bit of what we, unfortunately, you just went over this Saturday, okay? But this has been a high demand to do this, so I'm bringing it up tonight with these folks. And if you've got any input, Rob, or if you got a problem, you know, just give me a shout out. I'll bring you live. We can bring in some numbers, and we will maybe help you analyze the property. So first things first, let's go over the example. Okay, the example is an older property. Let's see, it was listed for, I think, 80,000 bucks. I think I sold it for 70. And I'm gonna right up top here, we always list the income first. So the income on this property at the time was $13,800 a year. There was 2 units. The other one was a 3-bedroom rental for rent at these prices anywhere in the U.S. or Canada. Well, actually, there are places rents will be higher. Just remember, you got to keep things in perspective here. Everything's relative. So we're just going to use this example here, and we'll go over other examples later. But in case, that's the income, $13,800 per year. The expenses are taxes, and these are actual figures, $695 for taxes. Insurance was $322 for the year. Water was $1388 for the year, which included sewage and garbage, by the way. Okay, and maintenance and repairs was $600 a year on average. Now, I want to point something out here. Maintenance and repairs in this example are only related to small items. Anything that's larger, like you're replacing a roof or siding, we consider that a capital improvement, and that goes into a different bucket, okay? So for the sake of this exercise, we wanted to keep it basic and simple. So in any case, you have your total income coming in, $13,800 per year, and you have your expenses, all right? Total expenses, if you add all this up, you know, 600, let's see, that's going to be roughly 22,000, maybe about 3,000 per year, okay? The bottom line is this: if you subtract your expenses from your gross receipts, which is $13,800 per year, you're left with a net operating income of $10,793.54. Okay, so far so good. Okay, so in any case, bottom line is this: you add up your net operating income, you add to that your expenses, you should get back 8. So that's the formula: income minus expenses equals your net operating income, and that's on an annual basis. To get a monthly basis, obviously you divide it by 12, and as it turns out, this property has a net operating income of $899.46 per month. Now that's just your income and expense. This does not include debt service at this point. We'll go over that in just a moment, okay? First things first is we got to figure out what is the sales price. In this case, this property actually sold for 70 grand, okay? The investor put down $14,000, which is 20%. That's pretty standard, and I kind of agree with that actually. So the investor, the purchaser, put down 20%, which is 14,000. 20% is 70, which leaves a loan balance of 56,000. In other words, this investor is looking to get a loan for $56,000. Now, the term here shows 20 years, and the interest rate shows 5%. And I can't remember, but I think that's actually what it was. But to be honest with you, so in any case, as an aside, I like 20-year terms. I've studied this through some CCIM classes, and it turns out that the optimum term is 20 years. That's why I like it. As a matter of fact, if you study the value of borrowed money over time, in other words, if you look at future value of current cash flows and current value of future cash flows, all this stuff that's beyond the scope of this class tonight, just know that we've arrived at the philosophy of using a 20-year term. Okay. In any case, if you figured out the math on that, 56,000 for 20 years of 5%, turns out a monthly payment would be $369.58. Now that's just principal and interest. Okay. It does not include taxes and insurance. Remember, taxes and insurance were included up here. Okay. They're called non-debt expenses. Debt is strictly $369.58. So if we subtract $369.58 from $899.46, we get a cash return of $529.88 per month in our pocket. That's what we call a cash on cash return. Okay. Again, just to repeat, net operating income does not include debt service. Okay. Cash on cash return does include debt service. So net operating income of roughly 900 minus debt of 370 roughly gives you 530 per month. Okay. On an annual basis, that gives you $6,358.56 per year. That's not a bad deal. Now keep in mind, we're not showing here things like vacancy, and there's other things you factor in. We just want to create, we want to show the basic formula and what most people are going through, because most people don't count on vacancy. I mean, I've had properties where my occupancy rate was greater than 100%. When I factored in the people that paid late fees and forfeited deposits because they left early and things like that, my actual gross receipts was greater. Okay, it was greater than 100%. So just bear in mind that that can happen. Also, there's other things not here like management fee. I would just instruct you in this regard here. When you're buying properties, even if you're going to manage them yourself in the beginning, that's fine, but always include a nominal, at least nominal management fee. The reason is if you grow successfully, you grow your portfolio successfully, at some point you want to have property management in place. Now, if you've already accounted for it at the time of purchase, you're in good shape. If you didn't account for it, at some point you've got to pay the piper. Okay. In other words, you've got to come up with that management fee at some point in your ownership, and quite frankly, it may put the kibosh on your plans to use property management. So I suggest you include it right from the start. In fact, let me just check for questions here real quick before we get into the ratios. Let's see here. We got a lot of feedback. Hot diggity dog. This is good. This is a good night. I love it when you guys participate. Okay. Oh, somebody says I'm going in and out. Looks like I'm 100% now. I am using, obviously I'm in a hotel. Sometimes their Wi-Fi is a little spotty. Right now it looks like it's pretty good. Okay. Mio is asking, how can we find tax, insurance, utility repair, reserve? So Mio, when you're looking at properties to purchase for you or your clients, you always want to ask for last 3 years of P&L. That's profit and loss, which gives you the income and expense for the property. So they'll show you what they actually had to pay out in the way of taxes and insurance, water, sewage, garbage, maintenance, repairs, and so forth. Okay. You can also find on your local tax assessor's database. It's loaded at the county level everywhere in the country except for, I believe, New York and New Jersey. They load it at the municipal level. They'll give you the property tax there. They often will give you the rate the actual percentage and the actual amount for every property, okay? But nonetheless, whenever I'm looking at a property, I make it mandatory that I see this information, actual information, and I also want to see Schedule C, Schedule E of their tax returns. Schedule E is what reflects the income expense directly related to this property. And if you ever have an investor, a seller, balk at that and say, I'm not going to provide my tax information, remind them you're not asking for their personal information. We don't care to see their entire tax return. We just want to see Schedule E that pertains to this particular property. Very legitimate request, and if they don't want to provide it, I'd move on, okay? So in any case, Mio, I hope that helps answer your question there. Let's see, this is Peter. What is the threshold on capital improvements? Actually, Peter, believe it or not, last time I was involved doing this own taxes, it was actually $250. Now, I want you to just know this. I'm not a tax accountant. I'm not an attorney. However, I know lots of investors who will actually expense their capital improvements. Now, there is a way you can do that. I have some accountants, oh, you can't do that, and some absolutely can. I believe it's called Tax Rule 172. From what I recall, Tax Rule 172. So what that means is, let's say you bought a refrigerator for $1,000. You could depreciate that. In other words, you could add to your cost basis right? Basis. And then you would depreciate that. You can depreciate on a 5-year basis, okay? It's an accelerated basis. So you either get to choose to do that, apply to the cost basis and depreciate it over time, or you can take it as an expense. Now, remember, don't say Gary Wilson said to do this. I'm just telling you, I actually did do it. All the years, every year, all the years I've owned properties, I've always used Tax Rule 172. And I've expensed everything except for really large items. So Peter, back to your question. Now, if I'm putting on a new roof for $5,000 or $10,000, I'm absolutely going to put that on cost basis and depreciate it. But if I'm doing little things, doors, windows, things like that are a few $100s, I'm gonna expense those. And I don't mind saying that publicly because you can see my tax returns. I've done that for years, and I've been audited, and I've never had anybody say you can't do that, including the IRS. So that's my experience. I suggest you work with your tax accountant and have them verify that for you. So good question, Peter. I appreciate you bringing it up. So Karina's asking about management fee. Yeah, actually, Karina, I appreciate you bringing it up. I probably mentioned that after you asked for about management fees. So I like to include management fees when I do my initial analysis on a potential purchase, only because I know that I will turn it over to property management. Years ago when I first got started, I didn't do that, and my mentor told me, even if you manage yourself, Gary, you should include that, and I started doing that, and thank goodness I did, because you better believe I absolutely turned it over to property management. And as many of you know, I actually built my own property management company, and I ran my properties through the company while I owned the company. I eventually merged it with another person. And I did that because I wanted my clients to know that I was running my properties the same way I run theirs. And I also wanted to know and experience what my clients were going through. So wonderful technique, by the way. Okay, so this is Faisal. Faisal says, how did you figure out the maintenance fee again? Okay, hang on one second. So Faisal, that was maintenance was just based on an average across all my properties. In other words, just basic, changing the key, the door lock on a property, doing minor maintenance and repairs, things like that. That's really all that was. So it didn't include capital improvements. So that was just an average based on my experience. Good question. Okay, let's see here, guys. Let's see, what else do we have here? So Karina's asking, what is an average management fee to put in the budget? Karina, it actually depends on where you are. If you're in a resort area, you actually will pay 10%, sometimes more. Now, if you're in like a heartland city in the middle of the country, things are pretty well, you might pay 7 or 8%. I have seen situations where people are only paying percent. That's extremely rare, and that's usually the result of them owning, say, a 200 or 300 unit building, and that's my case. So I've got some big stuff, and when I manage other people's large properties, we would lower the rate, okay, because obviously there's an advantage to me managing a bunch of units. Some parts of the country, 1 second. Let's see, hopefully we got there. Actually, oh, there we go. Okay, let's see, this is, who's the next one? Oh, Miho, yeah, I'm sorry, last 3 years of profit and loss is what you want, okay? Basically income and expense. Okay, let's see. Yeah, everybody's saying tax rule 179. Thanks, guys. Yeah, I use that. I've been doing this for 31 years. There's never been a year that I didn't use it. Okay. Let's see here. What else do we have question-wise? Can you repeat that from the fridge? Yeah, so Omar, when you or your clients purchase appliances, you would depreciate them on a different scale that you would depreciate the property itself. I believe it's 5 years for appliances. It's called accelerated depreciation, allows you to recoup the cost of the appliance over a shorter period of time. But remember, anytime you take depreciation, it's not like a permanent write-off. You actually have to recapture that when you sell the property. So keep that in mind, guys. A lot of people misunderstand that. Yes, you get to write off 3.41%, okay, each year of your cost basis. But when you go to sell, your cost basis is reduced by the amount of depreciation you've taken over the years. So real quick, we're getting way off tangent here, but since it's come up, let me mention this. So let's say you purchase a $100,000 property, and over the next 27.5 years, you depreciate it all, 100% of it. That's $100,000 depreciation. Okay. What'll happen when you go to sell? The IRS is going to consider your cost basis to be zero, because you purchased the property for 100,000, but each year you wrote off $3,411 or something like that. Okay. Well, that's not free money. That's just borrowed money. Okay. You got a tax break on a temporary basis by doing that phantom write-off. So when you sell the property, the IRS is going to offset your cost basis with what you depreciated. So just bear in mind, at some point you've got to pay the piper on that. Okay. Let's see here. Let's see. Okay, you like that depreciation? No problem. Yeah, I still depreciate. Okay. Okay, I think that's all for the questions. I think that's all for the questions right now. Let's see here. Okay, let's continue on, guys. What I want to do is I want to show you. So Roger, here's one. Is there a method to determine property manager fee rates for commercial rental units 6 to 10 and above? Yeah, so Roger, what I did is I actually joined my local property management association. They called it the Apartment Association. And when you're in there, you get access to all this information for free. It doesn't cost that much. But you can also Google it. You can Google your area prevailing, just Google prevailing commercial property management rates for, your area in New Jersey, okay, and it's public information. You should find that, and also it's going to vary depending on the type of the property. So industrial will be different than commercial. Commercial will be different than retail. Okay, so just bear in mind that you can't use carte blanche formula for all the different types of non-residential. You have to actually determine what industry you're in and then find the appropriate rates for that industry, okay? Let's do this, guys. I want to use this spreadsheet here. This is the basic Excel spreadsheet. Oh, hang on one second. This is the basic Excel spreadsheet that we use for analyzing rentals. So let me reduce my panel for a second, and I'm going to bring this up to the top. Okay, so here's the property. So here's the property, the subject property. Okay, purchase price $70,000, mortgage of $56,000, which leaves a down payment of $14,000. So far, so good. Okay, now we're going to go down here and plug in the mortgage information. So we're going to have a 12 payments per year, 5% interest rate, 20-year amortization, 20-year term. And you can see that makes our mortgage payment monthly $360